Yo, what's up? If you guys aren't following me on Instagram, it's probably where you should start. I'm gonna just do a quick video breakdown here of this trade that I took Friday. So this is kind of where I initially entered. This is where I scaled in, and this is where I eventually got out. And these are the executions right here, which 44.50 was kind of like my target, which actually ended up being the overall high of day 44.77.50. So the target ended up being the high of day. So I kind of want to break down how I kind of came to that conclusion and got in where I got in and got out where I got out, which was eventually the high of day. So first you have to understand the overall narrative or the overall bias on the day. And bias comes down to four things. Let me create a text wrap. First thing is weekly profilings. Second thing is daily profilings. Third thing, higher time frame structure. And the fourth thing is intermarket analysis. These are the four things that kind of give you a bias coming into the market, and I'll kind of explain them. So when you create a bias, it starts from the weekly time frame. It doesn't start from the M15 or the H1 or daily. It starts from the weekly because something called the weekly profilings, which you have to understand how a candlestick is formed. So let's say this is the open, and this is how a candlestick is formed. This is the open, put this up top, and let's say down here is the close. Down here is the close. This is the open, this is a close. This is how a weekly time or a weekly candlestick is formed. Price opens up, goes higher, so then you have your little stick right here, so your wick. Let me make this a little bigger. This is your wick. Price opens up, it goes higher. Let's say it goes higher a little bit more. And then price drops. This is your body and this is your wick. Let's say price drops all the way down here. Then you want to extend this wick all the way down here. And then price comes back up right here. Somewhat resembles this, right? You guys can see. Somewhat resembles it. This is a bearish weekly profiling. This is bearish. Then opposite can be said for bullish. This is your overall open. Open. Price starts off in the red. Starts off in the red. Get your wick. Starts off in the red and then creates a low. Comes back up higher. When it comes back up higher, it's now green. Let's say up here is your close. Close. and this is your close. So price comes back up here. Extend your wick. Say it goes a little bit higher. Comes up here. Then it comes right back down. This would then be classified as your bullish weekly profiling. This is a bullish week. This is a bearish week. So inside of these two subsections, you have the daily profilings, or actually continuation of the weekly profilings, but in a daily format, which I'll explain here. Just make this like clear. So this is your bearish week. Remember how it opened up, went higher, went lower, then come back? So let's draw that out here. We open up right here, went higher, created this high, dropped, came back, dropped, came higher, and then ended up back like right here. This is a bullish week, or a bearish week, I should say. And the opposite can be said here, where we actually open up, go, actually, we open up, go lower, create a low, push higher, back down, create this high, and then drop off right here. This is a bearish week, weekly profiling. This is a bullish weekly profiling. Say this was Monday, Tuesday, Wednesday, Thursday, and Friday. This was Monday, Tuesday, Wednesday, Thursday, and Friday. This is where you get your concepts for the low of weeks, where a low, when you're expecting the candlestick for the week to be bullish, you expect either Monday, Tuesday, or Wednesday to create a low for that week. When you're bullish for the week, when you're bearish for the week, you expect Monday, Tuesday, or Wednesday to create the high for the week. Some of your daily profilings can be like right here where it went lower, it created this high, went lower, 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 and then pushed higher. That could be either a Thursday reversal, where if we've been making consistent lows, day after day, we could see a potential pullback Thursday, or right here, this last move higher, which is called a TGIF. TGIF, which is thank God it's Friday, where if we've been making significant lows throughout the week, we've been going lower, 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 we could see Friday make a pullback reversal. And same thing for a bullish week. So you have your weekly profilings, which is in the shape of a candlestick and in the shape of the weekly, the weekly, the entire weekly time frame. So you open up, go lower, come higher, and then come back. You open up, come higher, drop lower, then come back right here. This is how you get your daily profilings, which is Monday, Tuesday, or Wednesday high of week. You get your Thursday reversals and TGIFs. So we got that for the weekly. Next, we had higher time frame structure. Let's move all of this over here. Go over here. Next, we have higher time frame structure. So coming into the market here, let's go on the H1. Remember the weekly profilings I mentioned? So this was a bearish week. So this overall was a bearish week. And when we have a bearish week, when we create a high and we keep going lower, we could see a potential pullback or a, bullish reaction on Friday, which coming into our market, that was my anticipation. We've been going lower, lower, lower. We created a high Monday, so this would be the high of week. We've been dropping lower, 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 lower. I was bullish Friday because of something called TGIF. Thank God it's Friday. And I was also bullish Thursday as well because of the Thursday reversal, as well as we reached up into our draw on liquidity for the week, which was kind of this bullish fair value gap. Or if you don't trade ICT, it came down to a support area for the week that I was looking for, and it's Thursday, so I was bullish. So the third thing, the third and fourth, higher time frame structure, and fourth would be intermarket analysis. These are the third and fourth things when forming your bias for the day. You come to the weekly, you look at the weekly profilings. Are we bullish or bearish for the week? We were bearish for the week, right? So when we're bearish for the week, this is how a classic sell week would look like. It comes up, create a high, drops lower, comes back, makes a slight retracement, drops lower, and then this is where we get our Thursday reversals, and thank God it's Friday. And opposite can be said for bullish weeks, where we drop lower, push higher, break above the open, come back to the open, and then rally higher. This is where you get your Thursday reversals, or thank God it's Fridays. And that's kind of how these weekly candlesticks are formed. So now that you know about the weekly profilings and the daily profilings, there's more to it, but those are the two that you should be aware of. Your higher time frame structure. When you're bullish, actually let's say bearish for the week, price should respect your bearish areas of resistance. And when bullish, price should support your areas of support. This is the overall narrative. So we have this bullish fair value gap here, but we're bearish for the week. Since we're bearish for the week, we're not going to look at this as support. We're going to look at it as an inversion where price can come down, tap into it, break above, break structure, come back, and then continue dropping. That's an inversion. This is what we see here. Broke lower, came back above, drop. When you're bearish for the week, until your draw on liquidity have been met for the week, wherever that may be, whether it was this fair value gap or this low or wherever, you continue to be bearish. So our drawn liquidity for the week was this bearish fair value gap 50% and lower. This is where we want to see price come down into, and we did. We came down into it. So since we reached our drawn liquidity for the week, or where we want to see price come to the week, I'm not looking for shorts anymore. Why would I then continue looking for shorts, when we've already met our drawn liquidity? This could be a different story if, let's say, our drawn liquidity was down here. Then I'd continue looking for shorts, or like right here. But we've already made significant 97 points on the week. I'm not looking for shorts anymore. So having that higher time frame draw on liquidity is important. Where do you want price to go for the week? And after it's met its target, what's next? Where does it want to go now? Which is, kind of where you kind of have to sit on your hands a bit. But this is where the weekly profiling and the daily profiling comes in hand, because let's say we met our drawn liquidity here, I now know to be bullish because it's a Thursday reversal, compared to the guy who seen the drawn liquidity right here, tried to go long, and then lost. Because this isn't a Thursday reversal, this is Wednesday. Wednesdays are usually a continuation of whatever happened the previous day. So since we were bearish Tuesday, I'm looking at that Wednesday as a continuation lower into the drawn liquidity. Unless Tuesday had such a significant move lower that it's already met the drawn liquidity, then that's when we can get into midweek reversals. But that's a different story. But yeah, so Wednesday I was looking for shorts. Thursday I was looking for longs coming into a market open, which it did give us. It created a Judas swing at first, but then eventually went long. And then Friday I had the bias to go long again because of what I say, TGIF. This right here, when we've been going short all week. This is, Monday created the high, Tuesday dropped lower, Wednesday dropped harder, Thursday reversal, TGIF, Friday is bullish. Not only that, but you have to look at overall structure. This created a low that took out this low. Then this broke structure to the upside. This broke structure to the upside. Do you know how they're like higher highs and lower lows and higher highs is an uptrend? This is it. This broke structure to the upside, created a higher high. Now it's going to start creating a higher low. This is bullish, so I'm not going to want to short this, because I know some people may see this bearish fair value gap at the open and they might have tried to short this. I'm not going to want to short that because I'm aware of the higher time frame structure. Higher time frame structure is bullish. Why am I going to short inside of a bearish fair value gap? Then we have, last but not least, intermarket analysis. This is where you look at other pairs, other indexes that are correlated to yours, and form a bias based on their structure or where they're going. So, reason why I was so bullish today or Friday was because look at this. ES took out this low. Nasdaq took out this low. Dow Jones, it didn't take out this low. See that? It didn't take out the low, but ES, Nasdaq did, but Dow Jones didn't. That's on SMT divergence. And on the higher time frames, it can be really powerful. So seeing that signature alone, plus the higher time frame structure, we broke structure to the upside on the higher time frames. Coming into Friday, I had a bullish bias. I wanted to be bullish on the day. So before you start the trading day, these are kind of the 4 commandments that you have to look at. And then higher time frame structure and intermarket analysis, as well as looking at the dollar. In the beginning of the day, the dollar was bearish. The dollar was extremely bearish. Dollar broke structure to the downside. Same time that, around the time, ES broke structure to the upside, dollar broke structure to the downside, came back into this area of resistance, and then it was bearish. So once again, using other markets to form a bias on my market, even though I don't trade dollar, and I can't trade dollar because it's not a future, I can still use it to my advantage to predict where ES is going to go. So seeing that the dollar was bearish coming into the open, plus we had the SMT divergence at these lows with with the Dow Jones, plus the fact that it was a TGIF weekly profiling and the TGIF daily profiling, where it's usually bullish on the Friday after a continuation move lower throughout the week. It's just stacked confluences. So I was confident coming into a market. I wasn't looking to get short coming into a market. So coming into a market here, 9:30 opening. So we have our bias. Our bias is bullish. We want to be looking for higher prices based on all the confluences I mentioned. And it takes time to create a bias. It takes time. You have to look at every time frame from the daily to H4 to H1 down to M15. You have to, identify areas of resistance, areas of support. So that's when the market opens. So we marked out what we want to see on the daily. On the daily, we had that SMT divergence with the Dow Jones. So now coming down to H4, we see this right here, this bearish fair value gap. Let me remove this real quick. This bearish fair value gap right here on the H4. Okay, so if we were to be bullish, this is an area where I'd want to see a measure of, resistance if we were to be bullish, which we were. And then coming down to H1, fair value gap gets a little bigger. This one we can split in half. Equilibrium. This is the midpoint right here. So at this level right here, in the middle, hold on, at this level right here in the middle, this would be an area where if price started to potentially retrace at or start to get weak at, I would then close out of my position or scalp off my position. So on the daily, we had the SMT divergence with the Dow Jones. That was that. On the H4, we had this bearish fair value gap. On the H1, we had this, bearish fair value gap again, but a little bit higher and a little bit more precise. It's a lot more precise. Now we have a 50%, as well as the overall structure: low, lower low, higher low. Broke the structure. Price then goes from making lower prices, break structure upside, to start making higher prices. As you can see, comes down, retraces back up here, finds resistance, breaks lower, comes back up here, break, but it does not break this low, that strength. So now at this level right here at the opening, I'm bullish. There's no reason for price to then drop. We've already met our drawn liquidity. We've met where we met our draw, where we wanted price to go for the week. We've already met. There's no reason to see it continue going lower. We'd want to see it come back to 20 to 30% of the weekly range, which is TGIF. TGIF is based on the weekly candlestick. If we take this fib right here from low to high, price then stops right here, 20 to 30%. 20 to 30% of the entire candlestick is where price stops. That's TGIF. So overall, coming into a market, I'm bullish. In my targeting, my first area of targeting was this overnight session high and up here in this H1 bearish fair value gap consequent encroachment, which is this 50% line. So coming down to M5, market opens here at 9:30. We have a bullish rally higher. I'm not buying that. I'm waiting for a retracement. I didn't buy right here, and I didn't buy right here. So why did I buy right here when I could buy right here? Let me put this right here. Why did I buy right here when I could buy right here? I didn't buy right here at 940 or 945, and I bought at 955 because of intermarket analysis. Dow Jones was not going higher. And it wasn't until 955 did Dow Jones come down, stop hunt these lows, and then started moving higher. So until the Dow Jones started moving higher, I was not going long. When easily I could have went long right here, and I could have easily got stopped out as well. But since I was paying attention to Dow Jones and where the Dow Jones was moving, and I was seeing the fact that the NASDAQ was going higher, the ES was going higher, but the Dow Jones wasn't, and seeing that gave me an idea to be more patient. And it wasn't until ES came down here, deeper into this fair value gap, and then started seeing a rejection higher. Same with with the Dow Jones, where it came down, stop hunt these lows, and then seeing a bullish reaction higher. Did I then go long? And when you're bullish, down close candles support price. So this is a bullish order block. So seeing this, how it came down, tapped the open, then move higher, I went long again. And my targeting was up here, 7 cent, because this was a 3 to 1 R, about 62.50, about 15 points. And I ended up getting out. So ended up getting out about right here, stop down here. Ended up getting out right here for about 13.5 points. And that was the trade idea. About right here. I did scalp off one contract right here, and I scalped another contract up right here. And that was the overall trade idea on from the higher time frames all the way down to lower time frames. Why did I go long here? What made me add on right here, and what made me get out right here? You know, it's a lot. It's not, trading is not as easy as, oh, it's at an area of support, let me buy, or it's at an area of resistance, let me sell. No, you know, if you want to do really well in trading, you know, it takes time. You know, you have to take the time to form a bias before the day starts. Before you start trading, you have to have a plan. You have to know exactly why you're coming into the market. Why did I come into a market? I was bullish. Why was I bullish? Because I understood that we have been making lower and lower prices. It was Friday. I'm bullish. You know, we've already met our objective for the week. We wanted to see price come down to a level of support for the week. We met that objective. I'm done being bearish. I'm gonna be bullish. And we've went through all the time frames from the daily. What did we find on the daily? The divergence with the Dow Jones. Dow Jones didn't take out this low. That's strength. That's bullish. That's very bullish. So the daily, we had a reasoning to be long. The H4, you know, we had a drawn liquidity. This is inefficient. Price has to come back up here to efficiently trade it. Price is not just going to create a low like this and then just continue lower. It's not just going to leave this area open. This is inefficient. It has to come back up here like this and then come down. This is how you get your classical market structure, lower lows and lower highs. It breaks lower, create an inefficiency, price comes back up into that inefficiency, trades into the inefficiency, then continues dropping. That's the whole point of lower lows and lower highs. It's not, there's nothing else to it. When price comes back up higher, price comes back lower, it's either taking out liquidity or inefficiency. So seeing this open, it has to come back up here eventually. And since, you know, we had that SMT divergence with the Dow Jones, you know, that's where we'd like to see price come back up into. So H4, we had our drawn liquidity, which was this bearish fair value gap. H1, we got our market structure, which is kind of this inverted head and shoulders, where it broke structure to the upside, came back, found support. You know, that's bullish. You know, it broke structure to the upside, created a higher high. When it creates a higher high, it should create a higher low. It does exactly that. I'm bullish. And as well, we have our more precise drawn liquidity, which is 50% of this H1 fair value gap. So we're being even more precise. Then we come down to M15. Um, Same exact thing. This then becomes an inversion. People would probably think of this as resistance, but you have to be aware of overall market structure and the bias. We're bullish. This isn't gonna be resistance. Price is gonna break above it, come back down into it to then pull higher. That's inversion. So we have this inversion. When we see this close above this bearish fair value gap and then price comes back down into it, you can buy that while it's aligned with your bias. You can buy that. And that's where I bought it. It broke above it, closed above it. It has to close above it. It has to close above it. So it closed above it, came back lower in the upper portion of that inversion, which is very good. And then looking at the Dow Jones stop once, then creates this rally. I go long, 62.50, stop loss like down here. Then I get out about right here. Actually 75, yeah. For about 3R or 13.5 points. And that was kind of the trade breakdown. The first key is having a bias, and you form your bias based on these four things: the weekly profilings, the daily profilings, high time frame structure, and intermarket analysis. What are other markets doing that you can use for your analysis to be either long or short? And yeah, and then, you know, just being patient. No, I could have went long, but I waited until the Dow Jones was then aligned with the ES, anticipating higher prices. And once it was, I went short. So I went long, I mean. I went long. And that's how you kind of get this. Then I got out right here. And as to how I got this high, or my targeting being the actual high of the day, uh it was just by coincidence, to be honest. I got in right here at 44.62. It was 15 points. I was looking at 15 points, and it ended up being a high of day. If I had held until the 15 points, because I got out at 13 points. If I had held at the 15 points, you could say I, sold at the top. But yeah, that's gonna be it for the video. I hope you guys learned something from it.